What's up, audit fans? Dr. Amanda White here, and today we're going to talk about significant risks. Now, students are often confused between business risks, inherent risks, control risks, significant risks, and the risk of material misstatement. And this results in a lot of lost marks in audit exams. Today, I'm going to untangle these concepts and give you 3 tips to help you identify significant risks. So, let's get into it. A big welcome back to all my regular subscribers, and hi if you're new to the channel. My name is Amanda. I'm a former auditor, I've got a PhD in behavioural auditing, and I teach auditing at university here in Australia. Now, today's video is in 2 parts. Part 1 is untangling the term significant risk, and part 2 will be my 3 tips to help you become a significant risk master. The term significant risk comes from ASA ISA 315 about understanding the client, and it really means what is the risk of misstatement or error that's material and likely to affect the planning and the execution of the audit. But what does that mean in plain English? Where do I find these risks? How do I generate them for my standards? Well, we need to start with sources of risk of misstatement or error in the financial statements. And there are really 2 main ones, either from areas that are more risky because of their nature, or because internal controls are missing or not working appropriately. Now, these 2 sorts of risks are called inherent and control risks, and it's important to be able to distinguish between them. The word inherent is in the clue here. The definition of inherent, according to the Oxford English Dictionary, is existing in something as a permanent, essential, or characteristic attribute. So that really means some characteristic of the client increases the risk of misstatement or error. For example, if you trade overseas in foreign currencies, there's a much greater risk of making a mistake in your foreign currency translation reserve. If you have a bonus plan based on the level of sales, you may have fraudulent manipulation by salespeople. For companies that have lots of subsidiaries, then there's a greater chance of making a mistake when you're consolidating all of those subsidiaries, double whammy if you've also got subsidiaries in different countries. So you might be thinking, inherent risks are significant risks, right? And you'd sort of be correct, and this is where things get a little bit complicated. In 2021, new ASA 315 will come into force. It's more detailed than what we see right now, and it's actually going to help us understand and unpick this situation. Paragraph 45 instructs auditors to identify risks of material misstatement and then do 2 things. Number 1, consider whether they have a broad financial statement impact or an impact on just a small part of the accounts or assertions. Number 2, evaluate the nature and extent of their effect. That is, what is the potential impact and what's the possibility or likelihood of occurring? So how exactly does that help us? Well, it means that we need to brainstorm all of the potential inherent risks for the client. Then we're going to need to evaluate them against their potential impact and the likelihood of occurrence and link them to an account or an assertion. Our highest ranking risks will become our significant ones. Now, I know your next question is going to be, well, how do I actually generate this list of inherent risks that will then become my significant risks? Well, this is where my 3 tips are going to come into play. Tip number 1, we start by knowing our client, and that's the whole point of 315. Know the client, their industry, their operations, their corporate governance, the company, and how it fits within the global economic environment. Once you know your client, you'll be able to identify where the potential for mistakes or errors in the accounting might occur. The exact areas that ASA 315 requires you to understand about the client can actually be used to help structure your analysis. For example, industry. Are there accounting policies within that industry that are unique or excessively complicated? For example, pharmaceutical companies and their R&D costs and how they could be accounted for. Mining companies have real difficulties in valuing natural resources stuck in the ground. We also need to know about the operations of the client. Are they multinational? Do they use foreign currencies? Do they use hedges? Do they have an increased risk of using the wrong rate or making a calculation mistake there due to the volume of their transactions? Clients that have lots of intangible assets have an increased risk around the valuation and impairment of those assets. If management receive big bonuses linked to key performance indicators, then they're more likely to manipulate those indicators and those accounts become greater at risk. We also need to think about the global environment. If you're an American company that deals with China, then there may be some risk due to trade tensions between the two countries. If they can't get the supplies or products they need, there could be an issue of going concern. Another example might be when a client is trying to refinance their debts. We saw that in Thomas Cook. The global economy had moved on from traditional travel agencies and the internet disrupted their business. They weren't able to refinance and restructure. Now, these are a few types of different inherent risks, but there are endless possibilities depending on the industry and the company, and you can only generate them by understanding the client really well. Now, tip number 2 is that business risks are not always inherent risks. Business risks are those faced by management, things that are going to stop them from achieving their business objectives. And they don't necessarily result in an increase in a mistake or an error in the accounting. An example might be in the mining firms. Mining firms' CEOs aren't really interested in the accounting issues around exploration and development costs. They're interested in what do the geological surveys say about where the next place is to dig. So we need to make sure that we separate out business risks and inherent risks. This is really, really important. Some will cross over, but quite often they don't. Tip number 3, see if you can explain why your risk increases the risk of misstatement or error. If you can't link the risk to an account or an assertion, then it's not likely to be a good risk. Now, an example here is competition. If you can't explain why competition in your industry for your client increases the possibility of error or manipulation, then it's not a risk. If salespeople received a bonus of 60% related to their monthly sales targets, then boom, you've got a clear risk because there's cause and effect. The incentive structure will cause or incentivize salespeople to manipulate the accounts, and that's going to affect sales, revenue, commissions with the occurrence and cutoff assertions. Now, identifying the important significant risks is the foundation of the audit. If you don't identify the risks properly at the beginning of the audit, then you risk missing out on detecting a material misstatement and giving the wrong opinion. And of course, nobody wants to get sued for giving the wrong opinion. So now it's over to you. Select one of the following 3 companies: Apple, Airbnb or Innisfree, and see if you can identify 3 risks that you would think would fall under the significant risk category. Put your risks and your explanations for why you think there are risks in the comments. In a later video, I'll share my analysis, my answers, and also your responses. I hope my 3 tips will help you identify significant risks and stop you from getting caught out and losing marks in your exams and assessments. As always, I'd appreciate a thumbs up on the video. If you haven't already, please consider subscribing to the channel, and you can catch me on Twitter, Facebook, and Instagram where I post and chat daily. Otherwise, I'll see you next time.